Hey, welcome to another VA Loan Success Day, and we're going to talk about VA loans and credit success. And, when you're dealing with mortgages or any kind of borrowing money, credit's got to come up. So we're going to talk about some of the little known benefits of VA where, it can be an advantage over other types of loans. So let's step right into it. Today we're going to talk about um, uh, minimum credit scores, and we're going to talk about no credit scores in some cases, and prior VA foreclosures and short sales, student loan debt. That's a big popular subject. Student loan debt's at all-time high these days, and then debt to income ratios. So we're going to discuss all these things in a little more depth. And as I always remind you, please reach out, ask me any questions anytime. So minimum credit scores. Each lender can be a little different. Now, some will go lower, but we're at 580. 580 is our minimum credit score for a VA loan. Doesn't mean if you get a 580 score, you're automatically going to qualify. The lower the score, the more difficult it is to get approved. But anyway, that is what we can go down to. And even if someone has no credit score at all, meaning no good, no bad credit, it is possible on a case by case basis that we could get that person approved. In a case like that, we're going to want to show, hopefully they have a verified rental history and some alternative credit references, such as paying utilities on time, gym memberships, things like that. So you can actually get an approval for someone with zero credit score. Assets always going to help. Compensating factors. We're going to talk about that in a little while too. But compensating factors always help, meaning you have money in the bank or in retirement, things like that. That's going to help you a whole lot in cases where the credit scores are not as high. And so let's say you do have someone that is in a lower credit score range. It may go from being what's called an automated approval, where it can make exceptions to higher debt to income ratios, things like that. There's certain requirements maybe and probably more limiting. Again, compensating factors, there may be low debt ratio, higher assets, time on the job. There's all kinds of things that could swing the weights over in the approval side instead of dwelling so much on a lower credit score. So anyway, just keep those things in mind and always ask about these things. Prior foreclosures and short sales, even if they're a VA foreclosure or short sale, many think that you can't use VA again. Actually, you can, assuming you qualify, and everything else. Um, you can have a VA foreclosure or short sale and still get this VA loan, and it is called using bonus entitlement. So someone may, in another scenario, own a house and then they want to have a second VA loan and own both houses at the same time. This is a little different, but treated the same. Part of their entitlement is going to be tied up from that foreclosure or short sale, and it's going to make it where we have to use bonus entitlement to have a second VA loan kind of at the same time, even though the other one is old and not outstanding anymore. It's an active loan. So that is something that is a great thing that you can actually use VA. And as you can tell by the screen here, it can be pretty quickly. So it can be 2 years as a standard seasoning on a foreclosure before you can get another VA loan. 1 year possibly, and it's with extenuating circumstances. Typically, that's not divorce or certain things like that. But if it's a major once in a long time medical type thing. There's certain things that I would encourage you to explain, talk to us about. Maybe there's something that can be done, but on all loan types, extenuating circumstances are usually pretty strict. But so at a minimum, 2 years on a foreclosure. Short sales. If a property was sold short of the balance, that's called a short sale, and there were late payments prior to that, then it's going to be 2 years. If it's same thing, you have some extenuating circumstances that can be proven, it could be as little as 1 year. Then there's an option of a short sale where there's no waiting period. That is where there's no late payments, and then a short sale is approved, and then there was a loss. Again, still tying up part of VA entitlement, but you can buy right away. So that's really cool. Student loan debt. Student loan debt, to my knowledge, is at all-time high. It costs so much to go to colleges these days, and so it's not unusual to see a lot of student loan debt. For a good number of years, because of COVID and other reasons, there's been a lot of deferred payments. And so many are not used to making payments, or they're income based and they're very small, but don't realize when it comes to getting a mortgage, often we got to count, certain payments, like agencies, FHA, for instance, if it's income based repayment, or no, I'm sorry, if it's deferred, they're not paying a payment. Well, we got to count half of 1% of the balance that's on the student loans. Same thing, Fannie Mae, Freddie Mac on conventional loans. It's either half of 1% or 1% of the balances. And that could make it harder to qualify. But so that's where VA does treat it a little bit differently. Number one is if someone has student loan payments deferred for greater than 1 year after closing, we can count zero of monthly payment for the student loans. Don't have to count them at all. That's very unique. And then if it's deferred for less than 1 year, there's a calculation, and that's what I put on there. You take the balance times 5% divided by 12 months, and that's the payment that we use. So that is how it is calculated with student loans for VA loans. Debt to income ratios. That is the monthly debts or payments that someone has. This includes things like child support or alimony too, plus the housing payment for the new property, divided by their calculated monthly income that we use. Okay, so if you are trying to qualify for a VA loan and have high scores, but mainly you get an automated approval. If we get an automated approval, it's not a typical 40-some% debt ratio as a max. It could actually be in the 60s. And I can remember one that was about 70%. They had a ton of assets. I mean, $200,000, I believe, in assets. Debt ratio was right around 70, and got it approved. But it's going to weigh out again those compensating factors. If it's way high debt ratio, but then really great assets, a bunch of money in retirement or checking savings, things like that, and you've got other compensating factors like a very high credit score definitely helps. Mortgage / rent history, maybe not much what's called payment shock, where their current rent or mortgage payment, say it's $2,000 and it goes to $2,000 plus or minus a little bit, or even if it's less, that's no payment shock. That means they're used to paying something like this, so they can handle it. Basically, that's what a computer's saying. So that is very cool that you can actually get approvals that high. Manual underwriting, it's going to be lower. So manual underwriting has their strict debt to income ratios on housing and total, but then there are exceptions to that. Again, if you got assets and other compensating factors that we will check out, those will help a whole lot. Also, it's not the whole story on qualifying in this area is not just debt to income ratio. It also has to do with residual income. It's used sometimes in other loans, maybe FHA occasionally for exceptions, but residual income is what's your income minus all the debts and taxes that you pay and all that stuff, and how much do you have left over to live on? And that is a calculation that VA has a minimum amount based on the number of people in the household and all that. But residual income can make a big difference. You may say, hey, I'm good on debt ratio, but then residual in the background, if it's not enough, it doesn't work. But if it's a very high residual income for the amount of people in the household, then that will also help you get approved at a much higher debt to income ratio. So that's a very good compensating factor as well. But it's always in the background on a VA loan. Grossing up income can help with a debt to income ratio. There are often a lot of things that are non-taxable when you're talking about VA loans. Whether someone's in the military, for instance, and their BAH and BAS are not taxable, that can be grossed up. VA disability or any kind of disability can be grossed up. Child support income, alimony, things that are not taxed can be grossed up. Generally, it's 25% of these amounts. So that can help a whole lot with a debt to income ratio. When it comes to just, this is more underwriting and everything, and you don't need to know this probably, but on residual income, if you do gross up your income on something for debt ratio, you got to subtract it back out before you do the residual income. Um, VA buy and sell, that's something we talked about before in other presentations. And that's where someone is moving from one property into another, and we don't have to count that current mortgage in their debt to income ratio. That's huge when you don't have to count one of your house payments in your qualification and don't have to sell it prior to this closing. That's huge. And then, as always, you've heard me say a bunch of times already, compensating factors help. Assets, length of time on job, the residual income, all kinds of things like that can really help. High credit scores. So a lot of things just um, can have flexibility, and it's helps when you have the experience like we do, our team does, and certainly underwriters, that we can find ways to make things work and in a sensible way, and of course a legal way, where it can work for a client when they're buying a house, refinancing and all that. And of course, they need to be comfortable with the terms as well. So that's basically everything we're talking about today. As I've said on all the presentations, realtors, picking on you now, just I'm telling you, be the expert. If you can know these things like this, even though some of it's credit and everything, you're going to have some conversations. People are going to ask you these things, even though you're not the loan officer. But if you can educate, communicate, and be that resource and know when to say, oh, you know what? That's more of a mortgage loan officer question. Let me get you over to Russell. That's a great thing. You can still be very knowledgeable, but still have that resource to share with them. Know what to look for, be prepared, and have your team together for success in this area. Again, hopefully that would be us on the mortgage side. Any questions you have on VA, please ask. I've got a Just Ask Russell section that I've just started on my YouTube channel, and you can see many of the questions that are asked to me and me providing the answers. So hopefully that helps you out. Next time, next week, next webinar is going to be marketing to military and veterans, and that's in whatever field you're in. But Hometown Heroes is a big deal. Our company, Alcova Mortgage, since I believe it's 2013, have been awarding deserving hometown heroes or military veterans or active duty military who do a lot in the community. Whatever kinds of organizations or individual type things that they do to help their community. We want to acknowledge those heroes, and that includes a $500 check, a plaque, and then they're on our website forever, and lots of sharing and marketing, things like that. And we make it a big event, and we want to get the TV news crew out there, the newspaper. We're gonna have a party and all that stuff like that, just because it's a big deal. And if someone, gives their life, their lifestyle and everything to, defending our country, and then they, even when they're out or still in there and they're doing extra in the community, that's awesome. And they deserve to be recognized. Share tips we've spoken about. We've given a whole bunch of things that are many of them outside the box type ideas that you can really share. And people are negative or say, oh, you can't buy a home or this hard and all that stuff. Share these things. I'm telling you, it will get people's attention. Donate your time and your funds. There's so many organizations that can get you in front of people that are veterans, and I say that to hopefully it's a true heart of wanting to give and help others. But when you do that, I'm sure it's going to come up. They know you're a mortgage person, you'll know, or a realtor or whoever. You'd be able to share your knowledge and be a positive factor in their life in all kinds of ways. And show sellers, we're a lender. Show sellers how to transition and be an investor. Transition, from one house to the next. There's so many things that if you can show them a lot of these tools, you can actually gain as a realtor the listing. As a financial advisor, you can show them a better way to move and to maybe become an investor, maybe save on their income taxes, things like that. So there's so many ways that you can market And when I say market, you're just sharing. I mean, I don't like to go, hey, gimme, gimme, gimme. I like to share. And hey, because if you give to others and just all this information, I may not get anything from this, but it's okay. But hopefully there's business there as well, and be able to help people even further, not just giving information, but also be able to hold their hand and walk them through a purchase process, a refinance, save their payments, things like that. But anyway, that is our slides for today. Hopefully that you've enjoyed this, and look forward to seeing you again on the next one. So have a very blessed day.